What you're looking at is a long-term graph of the stock price of Nike. If you bought Nike back in June of 2001 and held it until yesterday's close, you'd have earned over 17% per annum as a shareholder. You'd have turned $10,000 into $247,000. But note that Nike has had a really rough year this year. And if you looked at it for what it's done since November 5th of 2021, the stock is actually down 24.8%, and that's coming up to an annualized loss of about 50.7%. So we've had a bad year. The question is, has Nike fallen far enough this year to become an attractive investment? Stay tuned to the video and we'll be presenting that and covering that in greater detail. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, also known by many of you as Mr. Valuation. And I want to again welcome you to a subscriber request Tuesday video that I'm performing here. Now I do want to make a couple of points about these subscriber request videos. Number one, these are companies that subscribers has asked to look at. They're not stocks that I'm necessarily recommending, although there are some that I would recommend. And I'll be letting you know that as I go through the presentation. But the bottom line is, I want you to know that these are things that you, the subscriber to our channel, are interested in seeing. And so my job is to kind of go through each of them. For this particular week, I think I have 20 or 21 companies that I actually have 18 companies that I'm going to be reviewing. So I'm going to go through these very quickly. I'm going to look at them from different perspectives for you and then give you my opinion. Now, what you're going to see is you're going to see some dividend-paying stocks. You're going to see some examples of growth stocks. You're going to see some examples of, really highly speculative stocks in this group of things that you asked for. Now, one of the things I'm going to be pointing out as I go through this presentation is that you're going to be looking at stocks from the standpoint of how the business has performed historically, and then versus how the stock actually looks from a valuation investment point of view today. And I'm going to try to give you some investing principles and throw in a little bit of, sharing some financial knowledge and education that I've gathered over my more than 50 years of doing this. So I'll be interjecting that. But let's start with our first. We're going to go through them in alphabetical order as I like to do. Let's start with Amazon. Now, I'm looking at Amazon here as a long-term growth company, and I don't get a growth rate. I want you to notice that. So what I have to do is I have to take off an anomalous year to try to come up with a growth rate that makes sense for Amazon. Here I'm looking at operating cash flow. Now you can see Amazon's grown their operating cash flow at over 30%, and that goes back to 2005. And you can see how the stock price has tracked that. Now I want to make a point. One of the advantages of FastGraphs is you get a chance to look at the history of the business, how well the business has performed, how consistently it's performed, how fast it's grown, and you also get to see how the stock price correlates to that growth from a standpoint of the basic formulas we add, the valuation formulas we add to these stocks. And you can see there's been a very high correlation between the long-term results of Amazon and the growth rate. So when we go into the performance graph, you'll notice this is a non-dividend paying stock. We see that Amazon has generated a 27.37% annualized rate of return in contrast to the S&P, which has only done 8.47. And that is very consistent with the company's 30% growth rate, just adjusted a little bit for a slight undervaluation below the operating cash flow growth rate here. The question is Amazon as cheap as it looks on that graph? Well, there's a couple of things you want to do when you're using this tool. Now, I like using cash flow on Amazon because cash flow is a good metric. However, I can also use earnings on Amazon. And if I short the graphic, you can see that I still have a lot worse, if you will, correlation with earnings than I do cash flows. The company looks massively overvalued based on operating earnings versus cash flows, but the company is generating a lot of cash and the stock has been growing. Now, what I'm going to do is I'm going to go into the forecasting graph and I'm going to go back to operating cash flows and look at it from an operating cash flow point of view. Amazon still looks like it's very inexpensive because analysts are expecting cash flows to grow at over 29% for the next 3 years. And it's an average of these numbers down here. So I want you to also be clear about that. You always want to look at the pictures, see what you're being reflected, but also recognize how this number is calculated. It's expected to have a big year in 2022, over 79% growth, then settling more into the 27, 28% growth. So that number is somewhat contaminated. The long-term growth rate of cash flows is expected to average about 16.6%. So the reality of it is, it does look like the stock is still very inexpensive relative to its cash flow growth, but it does look expensive relative to earnings. But this is a high growth stock. Now, I want to talk a little bit about yields, cash flow yields or earnings yields. I like to see either operating cash flow or earnings yields at somewhere around 6.5% to 7% currently for the average company that grows about 6 to 8 or maybe even as much as 10% a year. But when you look at something that's expected to grow this fast going forward, a company expected to grow at almost 30% a year, I'm really more concerned with what the future cash flow yield is going to be. And of course, that's going to be a function of compounding, where the value is going to be related to how much cash flow it generates. And we're going to generate a lot of cash flow here. So with growthy stocks like Amazon, you're looking at future cash flows. I think if you're a growth stock investor and you're looking for growth, Amazon probably makes sense if you're judging it based on cash flows now. It does look reasonably attractive, but keep in mind, there's no dividend. You do have a slight margin of safety relative to its price to cash flows, but this is an aggressive investment. If earnings and or cash flow growth slows down dramatically, okay, that could change things. So that's something when you're looking at growth stocks, you always have to watch. But anyway, that's Amazon. I was asked to take a look at Amazon. So again, I'm going to go through these in alphabetical order. The next stock is Costco, and I want to look at Costco from a standpoint of cash flows also. Now, the white line on this graph is dividends, and I want you to notice that Costco pays a lot of special dividends. Okay, so when I go to the performance tab here, you're going to see that there's been a decent amount of growth in their cash flows, but they've also paid special dividends from time to time. So, that's something you want to take into consideration when you're looking at this stock. You can see a $7 dividend in 2012. You can see another $7 dividend in 2017, and et cetera. When you look at it, on the historical graphs, you see those dividends, real vividly here by the spike in the dividends. But those are special dividends. But here's what I want to point out. Costco has grown cash flow at about 10.9%. And there's a very high correlation. Now, what you're seeing with the fast graphs is you're seeing how the business has performed, how much cash flow it's generated, how much the cash flow growth has been, and how consistent it's been. And you can see that Costco has been a very consistent grower of cash flows. It did have a down year in 2016. This has an August fiscal year. You can see they had a down year in 2016, a down year in 2018. And then, of course, during the COVID years here, we've had some rather weak cash flow growth on the company. Again, that's to be understandable. But here's the point I want to make. I can see I've got historical evidence here that the market likes to value this stock at around, at something, if I hit the normal PE button down here, I get about a 14 times cash flow as a normal or a reasonable or the market's favorable valuation for the stock. It currently trades at almost double that number. It doubled that, 28 times cash flow now. So you can see a clear separation from the normal value. Now, great company, great results, great history. If I look at performance with this, again, like I did with, Amazon, you can see that we got over 14% growth, almost double the S&P. And by the way, in the future iteration, we'll be launching it real soon, we'll be able to collapse these quarterly results. I know some of you feel like it's too busy, but we've obviously tried to give you more detail on the performance results, but that's a coming feature. So I think Costco is really well ahead of itself. I'd love to own this company. I love this company. It's more of a growth situation than it is a dividend-paying stock, clearly. Forecasting, growth looks like it's expected to slow dramatically. If I look at it from the standpoint of operating earnings growth, we're looking at maybe 12 or 13%, some special dividends maybe, coming into the fray here again. But the reality of it is the stock looks overvalued. Now, there are a lot of metrics I can look at. And one of the things I want to point out is Fast Graphs gives you this historical look at the company, and you can see how the business has performed. You can see it's been a very consistent earnings grower. The market is like to price this at around 25 times earnings. The actual number is 26.01, but that's 25-ish times earnings. And you can see that even based on its normal multiple that the market likes to apply, Costco has gotten very expensive right now. So that means you're taking a lot of risk, to invest in a stock like this, notwithstanding the fact that it's a great business and really performing well as a business. The market, I always make a joke to say, to tell people that they know what the definition of appreciation is. And the answer is, the definition of appreciation is when others appreciate what you own more than you do. If I owned Costco, I would believe that the market is appreciating the stock a lot more than I do. And as you'll see in some future companies that I'll be featuring today, that can change and can change very rapidly. But I believe Costco is a great company, A+ rated, modest debt of 32% debt to capital, but extremely overvalued in my opinion. But we also got a platform here that you can utilize to do further investing. So let's take a look at Google now. Google's historical earnings growth, Alphabet is currently what the precise name. Alphabet has grown earnings at 37% historically. And on that basis, the stock looks dramatically underpriced. But again, this is an analytical tool. It's the fundamentals analyzer software tool, fast graphs. So what you do is you have the dynamic capacity here. I shorten this to the last 15 years, which by the way includes, 2 3/4 or so of forecast data. So it's not 15 years of history. But now we've got the growth rate down to 18%. Forecast growth rate is around 11%. Now remember, you're not buying the past, you're learning from the past, but you're always investing in the future. So I would say, there's a high probability that Google is a little pricey given the future growth. Now, it doesn't mean you'd lose money buying it here. You could still make 7 or 8% if it ended up reverting to a more market neutral PE of 15, But the point is, if you use the normal multiple in the stock of a 26 times earnings, it would still be very attractive. But keep in mind, that multiple that the company was generating or trading at was driven by the results that the company achieved. Now, I've got lots of cash flow metrics here. I got EBITDA and things, but another thing I like to look at is sales. Okay, and based on sales, the company still does look like it's a relative bargain based on its sales growth, which is going to be, relatively high at 16% going forward for Google is what the forecasts are, but that's less than the 20% that are currently traded at. So once again, we have no dividend here. You have a growth stock speculation with some high risk based on the fact that the multiples are so high. So there's Google. Illinois Toolworks is really one of my favorite companies on the planet. It's always been. It's a very solid company. If you look at it from the standpoint, it's A+ rated. Does carry a little bit of debt now. But notice how often the market has traded this at 15 times earnings. But also notice, as I'm analyzing this, how many times it's traded at around 20 times earnings, which is the blue line on this graph. But there are many, many times you could buy it at lower than 20 times earnings. Currently trading at 23 times earnings. I think even though Illinois Toolworks, and this is one of the examples I referred to slightly earlier, it has corrected quite a bit, but I still think it's got a ways to correct in my own opinion. I love this company. I always have. I'd love to own it, but I need to see it a lot cheaper than it's currently trading at. Even, based on its normal multiple for the last 5 years, it would look relatively inexpensive, but I can also analyze that because that's relatively high. We've been in this crazy bull market. So even if I, shorten that to a more normal or more neutral 20 times earnings, if you look at the long-term graph, it's about 20 times earnings. The company still looks overvalued on that basis. But once again, if I look at it from a standpoint of operating cash flow, I find out that, about 15 times operating cash flow is a very, very solid valuation to enter this company. It's got a 2.39% dividend yield right now. The stock has corrected, but I still consider it to be, I think the stock's worth somewhere in the 150-ish dollar range and is trading at 204, and that's how I judge that. Looking at the forecasting graph, I would get it back down to my $150. I'd be willing to buy it, anytime it got in these orange lines, but I'd prefer buying it when it was giving me a margin of safety. I love this company. I do think it's a little overvalued. Now, once again, I can look at all these different metrics and I still get the same answer basically when I look at Illinois Toolworks. So this was one that was requested. The next one is Nike, and this is the one I kind of introduced in the video in the beginning. And, when you look at Nike from a standpoint of putting the business result correlated to the stock price results, you get a lot different picture. You can see this has been a 15 to 20 multiple company, up and through 2013 for all these years with pretty decent growth rates. If I actually went back and took this scroll bar and took Nike back, I'd say it was growing at around 14% a year. That's from the time frame I'm starting here at June, as I said in the intro, of 2001 through May here of 2013. That's just what I scrolled in. And you see that we've got a 15 to 20-ish multiple valuation on this stock. High valuation is a 20 multiple. Fair valuation is a 15 multiple. And anytime you can buy it under that 15 multiple, it's good. Anytime you can buy it between 15 and 20, you're probably making a decent buy. Like if you bought it here, at an 18 multiple and held it to here, which at a 22 multiple, you made that 17%, rate of return that I showed in the intro. But the point is, very consistent grower, double digits. But now when I expand this out, excluding COVID, it's still a pretty consistent company. It did have some rather weak growth for a couple of years here, still averaging almost 14% growth. And keep in mind, these numbers really matter when you're looking at this. Now, if I shorten it again to a 15-year time frame, the growth rate drops down to 12%. If I click it here to 10, you can just pick any numbers you want here. It's now 13% growth. If I go to what the future is expected, the company is expected to grow at 15%, but I still consider the stock overvalued on that basis. A 31 PE has been the average for the last 5 years, but normally the PE is, the normal PE has been in the 20-ish range. We'll give it a 25 PE here as a fair average. I would still consider the company slightly overvalued. Doesn't mean you'd lose money, but it does mean you're not going to make a great deal of money going forward. Again, I don't rely on just this one metric. I also will look at it from a standpoint of cash flow, still looks overvalued. I can look at EBITDA, still looks overvalued. I can look at it from sales, and it still looks, dramatically overvalued. This has been a company that's normally traded around 2 times sales-ish, and for the last 7 or 8 years, it's been higher than that, but it's also had corrections. Even though it's had this big correction, I think Nike is still far, far ahead of itself. Nvidia is a really interesting one. A lot of people are interested in Nvidia. You can see the stock has had good 20% growth. You can see growth has accelerated in recent years. So when I shorten the time frame, the growth rate gets to be about 40%. Now, here's where it gets interesting. You got to ask yourself, is that a sustainable, growth rate for this company? It's a semiconductor company. Now, the forecast analysts think it's going to grow about half that fast going forward. They give it a long-term growth of about 24%, which is extraordinary, which again would make this a double-digit return investment, even if it reverted down to a 23 PE from a current blended PE of over 42. So there is growth here. When you're dealing with growth stocks, you need to look at them and think about them slightly differently. But once again, let's look at it from some other metrics. Cash flows look good. And if I look at sales, they look good. Now, remember, I said this platform gives you the opportunity to learn from the past, to see how the market has treated companies historically. But by going to these external links, you also have access to certain research. Some of them you have to subscribe to, where you can learn more about the companies just very easily and very quickly from the platform. My view of Nvidia is that the company has corrected dramatically this year, but I still think it has a long ways to go. I would not buy this stock here. I think the risk is too high. It virtually pays no dividend, pays a slight dividend. I just don't consider it attractive at these prices, even though it's a lot more attractive today than it was, say back at the beginning of the year here. It's had a pretty nice correction, but again, that's the risk of these overvalued stocks. This has been a big change. We're looking at December of 2021 here, and I didn't hit the very top. Just that correction has been 35%. That's severe for people, and people who've lived through that know what I'm talking about. They really get upset when they see their stocks go down 35%. Now, here we come into Polaris, and Polaris as many of those leisure products. They make snowmobiles, the ATVs, all-terrain vehicles and things like that. Been a pretty consistent grower. It did struggle during 2016, and it came from being overvalued. Again, you can see how the price tends to track the earnings, how the business results tend to reward the shareholders and/or hurt them if the stocks get out of whack. It's recovered since 2016. It's had some really nice growth here in recent years. You can see that the growth rate has accelerated to almost 15% a year. It's forecast to continue to grow at around 11 or 12%. Long-term growth rate, we're not getting one on Polaris, but the stock is offering a 2.4% yield. Looking at performance, you can see that the dividend has grown pretty consistently here in recent years. And even when you look at the company from a long-term perspective, even when they had some of the issues. And by the way, this would be one you'd want to look at cash flows for sure. They did have a little struggle with cash flows in 2021, but they still were covering their dividend. Their dividend has increased nicely over this 20-year time frame. The average growth of the dividend has been double digit. So I consider this one worth further research right now. I consider it, attractively priced at current levels. If you look at it, from a standpoint of any of these metrics, even price to sales, the company looks very attractive here. And you can see it's normally about a 1 or 2 times sales. It's trading at 0.78 times sales. So this is one that I would say offers you a margin of safety. Even from the forecasting graph, gives you about a 22 or 3% margin of safety. It has the opportunity to lead to some very strong returns going forward and a market, above average dividend yield of 2.4%. Now, in the last article I did, I had people, kind of raise their nose at 2.19%. I think it was on Stanley Black & Decker. But with the market around 1.8, 1.9, I'd have to check. That's the average dividend yield, in other words, of the market. A 2.4% dividend yield in this environment is reasonably attractive, especially if it's growing fast. So I think Polaris is a real attractive dividend growth stock at today's levels and offers you a margin of safety. They have reasonable amount of debt. They have not applied for a credit rating, but you can buy it with an earnings yield of 8.88%. This is one I would suggest you might want to take a deeper look at. Qualcomm has corrected. We've kind of begun to grow again, but notice that growth is leveling off. These are the kind of factors you want to be thinking about when you're looking at a stock. Just don't look at the price change. Okay, look at what's expected. So, right now it does have a margin of safety. You can buy it with a 7.6% earnings yield. The stock, is trading at a blended PE of 13, offers a 2.2% yield. The key is, though, it's expected to grow very fast this year. And by the way, their fiscal year ends in September, so that's coming up, not too far away. But then we're looking at very low growth for the next 2 years. The long-term growth rate, however, is expected to be 14.69%. And again, this tool was designed to help you research a stock quickly and efficiently. If I go into Yahoo Finance here, their analysts, which they get from Reuters, we get our data from FactSet, think 14.68% is what the future growth rate of Qualcomm is going to be. And that's basically identical to what the analysts at FactSet say. So this stock looks very attractive at these levels. Its growth, it's moderately cyclical. Even though it has a 15% growth, notice there was a period here where they had several down years in a row of earnings growth. These are all factors you want to take into consideration. However, the company did maintain their dividend during that whole time, and they did cover their dividend with cash flows. So these are the kind of things, valuation is a puzzle, and you want to look at everything from a price to sales point of view. Qualcomm also looks very inexpensive. So no matter how you measure it right now, I think if you were interested in Qualcomm, this looks like a good time to be, building a position. Now, Rio Tinto is a diversified metals and mining. I'm not real familiar with this company. I can go in here to the corporate website right from the fast graph. That's really what I'm trying to point out. And you can look at, they have iron ore, copper, aluminum, bromate, lithium, which is obviously batteries, diamonds, salt, titanium dioxide. These are things this company produces. So you can learn about the company directly from your fast graphs. But look at the cyclicality of it. Look at the dividend record. And you got to recognize when you're looking at a stock like this, even though the statistics look good, trades at 5.6, call it 5.58 times earnings, has a dividend yield of over 11%, earnings yield of almost 18%. But can you count on the dividend? Historically, statistically it looks great. The question is, what does forecasting look like? And analysts are expecting, and there are 21 analysts that are following this company here on FactSet, they're expecting negative growth. Long-term growth on this company is expected to be better, but they are expecting negative growth for the next 3 or 4 years. So if you're going to be investing in this stock, there's a high probability they'll be cutting the dividend. There's a high probability that you're going to run into a lot of bad news over the next 2 or 3 years. So this is the kind of thing that you'd want to check into and do more research. Now, you can go into sites like Seeking Alpha and find a lot of articles and opinions. I'd say some of them are from professionals, some of them are from, just crowdsourcing lay people. But you need to recognize the nature of the beast. This does not have the kind of consistency that would attract me. And even though these numbers look mouth-wateringly appealing, I would not consider this a real attractive investment, in my opinion, because I just don't think it gives me any, faith in how consistent my returns might be going forward. I'd be speculating in it, and it might be a short-term investment, but I certainly wouldn't want to be looking at this for the long term. Now, here we got a really popular growth stock like Shopify, and I do want you to notice that I'm going to take the normal PE off the graph here. You can see the company did have some massive growth. Look at the numbers down here, 238%, 138%. If I play around with the time frames on here, I don't really get any growth rates right now because the math is no, but I start getting some real high growth. But now the companies expect to have a negative growth of earnings of over 60% this year. The stock price has fallen dramatically. I mean, we can calculate roughly how much it's fallen, from its peak to trough. It's fallen about 73%. That's, again, another, lesson in volatility. Now, prior to this really bad year of earnings, if you looked at the company, it had pretty consistent and pretty good growth expectations. But, the reality of it is it's corrected a bunch, but it may have more to go. When you're looking at it from a forecasting standpoint, it looks like it has a significant lot further to drop. Now, looking at this company from other metrics, price to sales look good. Sales have really been the winner here. But even here, normal price to sales over 20, a growth rate of over 50, you're still looking at a stock that, got really expensive back here and coming out of COVID. It got really expensive. Currently, the price to sales is about 11.48. Normal price to sales is 21. We'll call it 20.7. So, this could be interesting, as a speculation now based on sales. But again, it's a growth stock. We've got no dividends. There is some issues expected based on earnings and cash flows for the next year or two. So again, you're looking at a lot of risk, even though we've had this massive correction. The question is, has it corrected enough? Anyway, that's Shopify, one that I'm not too interested in. I had a request for Sonoco Products. This is a cash flow growth of about 3%, decent dividend of over 3% if you're a dividend growth stock investor, and you look at it from a standpoint of dividend growth, you can see that the dividend has grown about 4 to 4.5% a year. Ish, roughly. So, you do have that going for it. If that's cash flows, forget about the correlation here. Look at the coverage of the dividend. If you look at it from the standpoint of earnings, it's been about a 5.6% grower. It is expected to have a really strong year this year. That'd be something you'd want to research and figure out. I don't really follow this company, but I was asked to look at it. So this year it looks good for the next little while, but then we're looking at very flat to negative earnings growth, in 2023 and 2024. And the question you have to ask yourself, what will that do to the stock over the next year and a half or two? And of course, only time will tell. But the point is, you need to understand the nature of the beast. Looking at it from a price to sales point of view, it's consistently about 0.9, or we'll call it 1 time sales. It would be a fair number, to look at it. It's currently trading at 1.01 times sales. So it's roughly, trading in line. It does have, a decent dividend yield. So Sonoco would be one that, if you're a dividend growth investor and you're looking for some yield, 3% might be attractive to you. Skyworks Solutions, this is one that looks very interesting on an earnings point of view. It's giving you a big margin of safety on earnings. It's a dividend-paying stock. It has close to a 2% yield. If you looked at operating cash flow, tremendous margin of safety. Again, forecast, to grow cash flows at over 22% a year. So again, if you were interested in researching, this is one I would take a much harder look at as well. I actually am long this stock. I like this company, but you have to make up your own mind. But I do think now is a great time to be entering Skyworks Solutions, simply based on valuation and margin of safety. And, this would be a good dividend growth stock, but also a good total return generator. If this stock just got back to, it's currently trading at a blended P of 10.6, just got back to a 15 PE, and these estimates were correct, you could have 20 to 25% annualized rates of return over the next couple of years on Skyworks Solutions. Now, here's Trulieve Cannabis. These cannabis stocks have been hot. If you look at them from a standpoint of sales, you get understanding of why the market is like them, but then you still see overvaluation. This is overreaction to sales growth. This is overreaction to the sales growth slowing down a little bit, you could argue. But if you're looking at it from a standpoint of normal metrics like cash flows and earnings, the stock does look overpriced. So, if you're a cannabis investor, you want to take all those things into consideration and look at it. It's a young company. We don't really have a lot of history. Forecasting, it looks like it's going to grow again. But I would consider this one pretty speculative and pretty expensive still, even though it has corrected dramatically over the last year and a half or two. The next one is Tesla. This is really an interesting story. We all know Musk. We all know what he's doing with Twitter now. We all know all the things that are going on. So, if you look at this traditionally from standpoint of earnings, if I get the normal PE in here, it just looks crazy. That's why it's not in there, because you just really can't even analyze it. I'll just use the last 9 or 10 years. I'll drop that down to the last 7 years. I still don't get any growth because I got negative numbers here, so I'll go down to the 6 years, and I'm still getting crazy numbers here, so we don't calculate them. Forecasting, it's looked like it's going to grow, expected to grow at 24% a year based on earnings. If I look at operating cash flows, about 25% a year. But here's where it gets interesting. If I look at Tesla based on sales, the company starts to look very interesting, because even though it's still maybe slightly overvalued based on that, it has the potential to still generate relatively strong, 7 or 8% rate of return. But it is not a cheap stock. I guess that's really what I'm trying to get across here. But it is expected to grow very fast, and, it's got so much uncertainty. And when I mean that, don't mean that in a negative sense, in terms of what this man might do next, who knows. But it's obviously been a very hot stock. But you can see when the valuation gets this high, this stock has had just an awful lot of volatility recently. But it's an interesting speculation for those, that want to do it. I'd like to see it cheaper for me to entice me, but, there it is. Here's Techtronic. Now, this is another interesting stock. If I look at it from a standpoint of earnings growth, even if I shorten the time frame and get rid of these, coming between the Great Recession and through even the COVID, quick sell-off, the stock looks very inexpensive here. It's forecast to grow at about 20% a year. Doesn't give a margin of safety at that level, but if I look at it from a normal multiple, I get a slight margin of safety. But the stock does look reasonably attractive considering the last decade or so, what it's looked like. It's a dividend payer. The cash flows disappeared in 2021. That probably explains why the stock price is down. You'd want to look more closely into that. If I looked at it from a price to sales point of view, it does look expensive. It's normally about a 1.3 times sales historically. It's trading at 1.8 times sales or 1.7 times sales. So, it does look expensive on that basis, but the correction has made this stock look interesting. It's one you might either want to follow or take a deeper look at. Unilever, personal products, it's had some, big spikes back in here. But if I look at it from a standpoint of earnings, 4.5% earnings growth. If I put the normal PE, the market has given it about an 18 multiple historically. It's trading below that now, so some might find it attractive. It gives you almost a 4% yield. A lot of cyclicality here, so that's something that you want to take into consideration. It also is an ADR, so as an ADR, an American Depository Receipt, you are getting exchange currency rates in here and so on. But, future growth doesn't look that astounding, but it does look decent at that level. If you're looking for a good, solid income producer, it's A+ rated, only has 30% debt. But again, what you're seeing here is, it's not in its own currency, it's in American dollars. But anyway, there's Unilever. It has gotten much more reasonably priced in the last 6 months or a year than it has historically been. And then Williams Sonoma is another one you've asked for. You can see how the price correlates to the operating performance of the company using earnings here. It's had a big correction. It's gotten really inexpensive. It does offer you a margin of safety, about a 2.2% dividend yield. Again, this is one you'd want to look at with all these other metrics. And, here we're concerned about dividend coverage or a great cash flow record for dividend. Free cash flow also looks very good. If I looked at it from a price to sales point of view, like I have some of these, still looks a little bit expensive, but, that's one metric of several I've covered here. From an earnings point of view, it does look very inexpensive and attractive. So Williams Sonoma is one you might want to take a lot closer look at and do some research. I think it's decent. Western Union is a slow grower. Some people call this company a dinosaur. It does offer almost a 5% yield. I'd look at it almost as an attractive bond alternative here. I use it in my income portfolios that I run for people. It's given me a nice margin of safety. I think this stock, is clearly worth at least 12 times earnings. You can buy it today at a 9 PE. So even if I'm using the forecasting graph here and I'm using the 11 PE here, this would be a 12 PE. This would be the type of return I think, this company can generate, with not a lot of growth, but with PE ratio expansion and a, pretty nice dividend yield. So there you have it. There you have these 18 stocks that I covered in this portfolio review. They range from really growth stocks, really speculative new stocks like Shopify and the Trulieve Cannabis, and et cetera. But the point is, you can look at a company from the standpoint of its historical operating results versus what it looks like today and how the market's been valuing it and what's expected to be in the future, and make some sound decisions. Anyway, this has been Chuck Carnevale. Long video today, almost 40 minutes, over 40 minutes already. I hope you enjoyed it. I covered a lot of stocks. I'm going to be limiting these to about 15 or 20 stocks, in the future, maybe 20 on these subscriber request Tuesdays. I'm going to try to feature some stocks that I like on other days of the week. But for the subscriber request, I really appreciate you asking. So I am trying to accommodate you. But as you can tell, it's very tough to do a video like this. Anyway, I hope you enjoyed it. If you did, give me a like, ring the bell, subscribe to the channel, and take a look at Fast Graphs. What a powerful tool. This is Chuck Carnevale saying thanks for watching.